Are the government-sponsored enterprises heading for another bailout? Investors are understandably still sensitive to signs of an overheated housing market, though the mortgage meltdown of 2008 is behind us. Recent housing price gains and continued scrutiny of the government-sponsored enterprises, or GSEs for short, continue to receive media attention for their potential financial market impact. Are true signs of trouble ahead? Let's take a closer look. First, who are the GSEs? The GSEs, including Fannie Mae, Freddie Mac, Federal Farm Credit Bank, Federal Home Loan Bank, and the Federal Housing Administration, also known as FHA, play a central role in the mortgage market. Rather than lending money directly to buyers, they purchase mortgage loans from lenders and package them with similar mortgages to create securities that are then sold to investors. This process facilitates residential mortgage financing. GSEs gradually improved their profits from the depths of the financial crisis in 2008 and returned to profitability in 2012. But earnings are now declining again, and that raised the risk of another cash infusion from the Treasury may be needed in the future. We believe this risk is low for now, however. Although there are a number of issues that can be implicated in the GSE's downfall in 2008, the bulk of the problem was due to an insufficient capital cushion to cover extraordinary losses in the event of a housing downturn, and also taking on too much portfolio risk. The capital cushion used to buffer against losses is driven by earnings, which in turn is driven by interest income on the GSE's mortgage-backed securities holdings, as well as fees earned from guaranteeing the principal and interest of the mortgages underlying those mortgage-backed securities. Interest earned on mortgage-backed securities holdings is the bigger contributor to earnings, but under terms of the Treasury's bailout package, the GSEs are required to gradually shrink their portfolios, which will reduce future earnings and profitability. Under the current agreement, these capital buffers must be completely removed by 2018, meaning that the GSEs will be required to pay any money they make directly to the Treasury. At that point, any quarter in which the outflows may exceed the inflows, the Treasury will be required to make up the difference. Aside from earnings, the health of the housing market remains the other primary risk to the GSEs. So gauging the sustainability of housing market health is important. And thankfully, another housing bubble does not appear on the horizon based on several key factors. First, let's take a look at housing prices. Housing prices, as measured by the Case-Shiller Home Price Index, saw double-digit gains in 2013 for the first time since 2005. But those gains appear to be moderating to longer-term averages rather than continuing to shoot higher. Second, let's look at affordability. Housing affordability has declined from peak levels seen in the aftermath of the housing crash, but levels are still high relative to the long-term average. Third, supply. The supply or change in housing stock was clearly growing faster than households' demand or formation in the run-up to 2008. Since 2009, the growth in housing units has lagged the growth in households. And finally, home ownership. While not every new household will purchase a home right away, home ownership rates are also below historic averages. This suggests that pent-up demand is ample relative to supply and may be simply waiting on the sidelines. So, while there doesn't appear to be a bubble in real estate now, at least at the national level, and the GSEs are in better financial shape than prior to 2008. Loans purchased are of higher quality and guarantee fees have been increased, both of which should help if home prices fall in the future. Furthermore, if loans underlying mortgage-backed securities begin to default, we expect the GSEs to make securities whole for investors. So while investors are not likely to be impacted under an adverse outcome, the GSEs still present a potential strain to the Treasury in a few years, as their capital buffers are being reduced and ultimately removed. The FHFA, or the Federal Housing Finance Agency, is keenly aware of this and has in fact raised the issue with Congress. But Congress has failed to act given the continued profitability of the GSEs, even if those profits have been reduced. And Congress has also failed to act because of potential political fallout. Although a future bailout risk remains, GSE reform and establishing long-term viable mortgage finance for individuals may unfortunately have to wait until after the 2016 presidential election.